Good afternoon, and welcome to this CoinDesk webinar series, Crypto Volatility Trading and Bootstrapping the Meme Surface. This is going to be a really excellent webinar that I've had a lot of pleasure helping to prepare for on a topic that's near and dear to many options market participants. So to get started, we want to remind everybody this is sponsored by and brought to you by Amber Data. Amber Data delivers comprehensive data and insights into blockchain networks, crypto markets, and decentralized finance, empowering financial institutions with historical and real-time fundamental on-chain and market data for research, trading, risk, analytics, reporting, and compliance. Amber Data eliminates the infrastructure setup, integration challenges, and maintenance headaches to access digital asset data, reducing cost and time to market for entering the digital asset class. We're delighted to be working with Amber Data. We, as a business, have worked with Amber Data and have enjoyed every minute of it. So it's delightful to be able to express some more partnership with them in this form of the webinar. Let's start by introducing our panelists, and then we'll get into today's topic. Greg Magaddini, a fellow CFA, head of derivatives at Amber Data. Nice to see you again, Greg. Kelly is the head of institutional partnerships and liquidity at Derive. Sam Chapal, another fellow CFA, is a crypto quant researcher. Ewan Sinclair is a portfolio manager at Hull Tactical Asset Allocation. I'm Andy Barham, the head of product at CoinDesk Indices. So this topic, I think, is probably on the scale of beginner to advanced, more on the advanced side. Options markets are one of the things that attracted me to the digital asset space years ago, to see how much excitement and volume and innovation was happening offshore, over the counter. But these are still fairly primitive markets with fairly concentrated sort of zones of liquidity. How to expand that to more strike prices, more maturities, and more assets remains a challenge that a lot of us would want to solve. So I think one of the innovations that we look to present here is what Amber Data is doing to try to help options exchanges basically complete more markets for altcoins by allowing exchanges to show volatility surfaces that will be reliable. So I think to begin that, I'd like to invite Greg to start talking about that model and really describe the innovation here, and then we'll take a look at how it's being implemented in different places. Take it away, Greg.
Absolutely. Thank you, Andy. So just kind of talking broad overview, there's a core problem with any new market. If there's not already options trading, how do you figure out what the value of the option market is, or where the values should be trading? So this is the problem that we essentially solve for, and this really applies to a lot of the altcoins. If people want to trade, for example, Pepe options and stuff like that, where theoretically should the options be priced? And until there's a liquidity convergence, it's kind of a little bit of a guessing game. And so we have a really reliable and consistent method to do that. So I'd like to show my slides here and kind of run through the slide deck. Perfect. Okay, so kind of showing you a brief methodology that we've decided to use. We take a non-traditional approach. Sam will talk about some of the ways to address this that he's seen in the industry before, but really working with Ewan, who's really the giga brain behind this, we caught a really good sort of different methodology. So the first thing that we did is we decided to reference the equity space. So, if we're talking about small cap equity stocks, biotechs, crazy things like that, they start to have a lot of meme-like jumpiness that you see in the meme coin world. So what we've done is we've taken the whole equity space universe, and then we've narrowed it down to stocks with liquid options markets on them and relatively tight spreads. And then from there, we paid a lot to get well-calibrated equity vol surfaces as the core set of ingredients for what we're doing. So now that we have essentially a basket of potential equities that we can calibrate to, what we do then is we take this altcoin of choice, or we could even apply it to other things such as like RWA indices and things like that, and we run a co-integration against that basket of equities and to see what's sort of the closest peer in terms of the altcoin of choice or whatever asset we're trying to calibrate to. And then from there, we take the top five. So we order them everything from the top five most co-integrated equities. And then we do sort of a equal weighting basket. And then this gives us a really good shape. So we can essentially see, how flat or how U-like or, smirk-like the volatility surface should be. And then from there, we need to adjust it up and down. So we do a historical Garchval model, and this allows us to get a good estimate of the altcoin historical volatility, both historically speaking, and we can project that out into the future. 7 DTEs and 30 DTEs are what we support. And this allows us to take that shape and essentially adjust it up or down in a fashion that mimics how the altcoin is actually moving. And then finally, we have a little bit of a confidence or interval as well. So, obviously the main moments that shape the volatility surface are the variance, the skew, and then the kurtosis, or how I like to think about it, the vol of vol. And so what we do is we look at sort of the median of those values, and we look at the distribution and where we currently are today. And let's just say that, median vol is 50, but for whatever reason today it's at 90, which is in the upper 90th percentile or some, crazy non-typical moment. Then what we do that adjusts our confidence interval. So the way that we present this volatility surface is we have mark vol, and then we have bid and ask spread. And what we did here to essentially get the spread is we looked at the liquidity on Deribit of Bitcoin, which is the most liquid, ETH, which is kind of the mid liquidity, and Solana, which is the lower of the three. And then we use similar spreads based on that confidence. And that gets us essentially sort of a nice initial calibration of a volatility surface for something that doesn't really exist yet. And so I think, maybe we can dig into more of the details there, but that's the general broad view outline. Oh, I think you're on mute, Andy.
My apologies. So it's a fantastic approach. US equities have the richest amount of data available, right? So that's a great place to start. You're starting with individual names, which reflect option users' behavior, right? And if you start with the idea that behavior is going to be similar for options users and try to apply that over, I think it's great. I have a bunch of questions building up in my head, but I don't want to bury the lead or ask questions that'll be answered in the description of the methodology. So I think it's great to proceed and hear a little bit more about the nuts and bolts of how this works.
Yes, I think one of the main interesting aspects was the co-integration step. Maybe Yuan, if you want to chat a little bit more about that.
Yeah, thanks, Greg. I guess it's it comes across as a very daunting task, right? Give me an implied volatility surface when there are no options and you really know nothing. The central insight here is that crypto is not special in a way that is particularly fundamental toward as compared to the rest of the options world. So to see this, if you do the really obvious approach, right, and you say, well, how has the stock moved around in the past? What would be the fair value of options based on that movement? You're not going to get anywhere near the right answer, because people don't buy options based on historical statistics of the stock. People buy options based on their risk preferences, their risk tolerance, what particular thing they're afraid of at any given time. And we have a huge amount of data of things like that. And if we look at it's all in the US equity world. And the central insight there is people will behave in similar ways if they're given a similar situation. So we look for stocks that are in some way similar to the coin we're interested in. And then we say, well, what did the curve look like for these particular stocks? So unfortunately, similar to is not a very well-defined mathematical operation. So we had to come up with some way of quantifying that. And the simplest, most robust way we could find was to look for co-integrated stocks. Well, stocks that are co-integrated with our coin. And all co-integration really does is it's a mathematical way of measuring how closely prices move together. So it's like if you look at this price and you look at another price and you say, oh, they're pretty similar, that's going to be reflected in a high co-integration coefficient. And then, as Greg said, we look for the highest liquid options markets that are co-integrated with our coin. We average across those options surfaces to come up with our new surface. And finally, we have to come up with some sort of anchoring volatility where we just use a fairly standard time series method of Garch-1-1 to estimate where volatility would be. So the whole thing is basically looking at the most similar things we've got. And the most similar just means price path, and then we rely on the fact that people have a fairly consistent set of risk preferences. And we know that from the options world because we can do similar things in getting one stock volatility surface from another. So this is actually not a new technique. It's just new being applied to the crypto world.
I love that. And again, this idea that regardless of the asset class, similar sets of investors are going to want to accomplish similar things, and they're going to have similar, I guess, risk budgets or risk limitations to achieve those things. I'm going to bring feelings to a facts fight here a little bit and say, I guess one of the things that we rely on with equity options is this assumption that log normal returns are normally distributed for equities, which underlies a lot of that. That may be a less reliable assumption for altcoins, for younger things that may have a very right-tailed distribution. Is there any sense that that these assets just fundamentally, maybe because of their newness, have a different return characteristics that might, I guess, interfere with how you're thinking about generating a volatility surface?
Well, there are two reasons I'd say no to your overall question. The first is that we've got 2,000 optionable equities in the equity world. So we have a lot of different things to compare these coins to. And we have as many crazy different equity volatility shapes as you can dream up. So in a sense, the equity world has already solved that problem. And the other thing I would say is this is a completely non-parametric approach, and that we don't assume that the underlying is doing anything. Mm-hmm. We're just assuming that similar things, no matter what they do, behave in similar ways. So even if it's a different set of investors, even if it's a much younger group of investors, it's a much more tech-savvy group of investors, we also rely on the fact that, people put in certain situations tend to behave in similar ways. So that's almost like a behavioral thing, which applies across different demographic groups. So we think this is a robust approach that handles what you're talking about.
Yeah, I think that's a really important point to appreciate. A lot of the many options people when entering the digital asset space the first observation is Bitcoin volatility skew is upward sloping and versus equity indexes, which is downward sloping. And I agree, and again, I'm bringing feelings to a facts fight that's based on behavior, right? Equity index skew is downward sloping because that's how people need to use those things. If you look at 2,000 equities, the same needs and use cases don't necessarily apply. So I guess what you're saying in more layman's terms is that if you're just looking at how people are using these assets, the options market should be able to serve them in very similar ways, despite the fact that one is very new and maybe one is very old and they're in different asset classes.
Yeah, I would say in this case, at least, your feelings correlate pretty strongly with the facts.
That's bringing facts to my feelings to a facts fight. Okay, you've analyzed that. That's good.
A meme coin and a meme stock have a lot more in common than, for example, Bitcoin does with the S&P 500. But we can find things that are similar. We've got so much data to look at. You've just got to look in the right space.
Right. I think as a theory, it's very appealing because, as you say, it's non-parametric. You're not stapling one to the other. You're just going back to the basic principle of use, expectations, risk tolerance, and objectives of the options user. That's brilliant. It's great. Greg and Sam, what was your what was your reaction to this, or at what point did you start to look at this project and describe your reaction to it, your contribution?
Yeah, for sure. So I think from previous experiences, working at a crypto options vol desk before, we saw some techniques on how to price these altcoin OTC options. And when we initially looked at how other market makers did it and looking at their methodology, it was quite simplistic in the sense that a lot of market makers would simply use some form of realized vol or variety of different realized vols and use that then to bootstrap an altcoin vol surface by then taking Ethereum and scaling it accordingly. And while that does tend to be still the approach that several industry players use to date, I think the approach that sort of we've worked on here on using the equity vol surfaces to bootstrap altcoin vol surfaces, I think the advantage of that here is that, as you had mentioned, it's non-parametric in the sense we're not assuming the kurtosis, or we're not trying to, first of all, calculate the kurtosis, the skew of altcoins, which tends to be a very difficult thing to achieve given the instability of these parameters. And B is the fact that we're able to systematically create vol surfaces on altcoins in a manner which is very scalable. So regardless of whether a market maker or a desk has their own pricing methodology, I think what could be of use is that there's a scalable and systematic manner to be able to reproduce vol surfaces in a relatively quick manner, which can be used to then to backtrack and confirm whether internal marks are adjusted towards what market might be pricing.
So I think that's, again, a really interesting point, that if market participants are used to saying, well, let's find an options market that's relatively used, and Ether is probably a better one than Bitcoin because it's at least not Bitcoin, and then say, I'm going to look at realized volatility information, take this Ether surface, and then that's all I have. You're going to have some limitations there, because, again, those options users for Ether may have different objectives in mind, right? Certainly from a meme coin option user. So you may be off in the wrong direction at a very early stage. Greg, how should we think about how this might have been tested, right? Because it's not as if you can have a bunch of participants and see if you're right or wrong yet. I mean, let's say that the theory is worth running with. What's in testing environment look like, and how did you harden up your confidence in this methodology to the point where you think it was ready to be used in practice?
Yeah, that's a great question. So we were trying a bunch of different solutions to figure out this problem, and I remember the first time Ewan showed me kind of this solution. He basically showed me the bootstrap Bitcoin surface and a Deribit Bitcoin surface, and they were just lying on top of each other. So this methodology converged to the existing market really, really nicely. And same thing with ETH. So that gave us a lot of confidence that this methodology could be applied to the rest of the altcoin space. So that's really sort of the key component that really convinced us that this is robust.
How does one of the difficulties, or one of the things I think that we hope grows in the options market for digital assets is term, right? And term is tough because farther you get away from today, the farther you get away from certainty, even about a forward, much less a volatility surface, right? And so a lot of the world likes 1, 7, 30-day options, but I don't know. I think many of us feel like a lot of the exposure in structured products, or for lending, or for risk management, is going to involve options that go out a quarter, 2 quarters, a year. To what extent, or how powerful do you think this kind of methodology can be extended as you extend that surface time-wise?
Yeah, absolutely. I'm happy to share my thoughts and maybe, you and if you have a different opinion, feel free. I actually think longer dated options are a lot easier to work with. So
Yeah.
if you think about like a 25% volatility asset, a three standard deviation move, that thing has to, move essentially 75%. But on a daily basis, essentially, it's a percent and a half or whatever it is. So the jump risk is very high with short dated maturities. And you see that a lot with different calibration processes. So like the Heston model, for example, can really calibrate the long dated stuff pretty easily. But once you start getting to the shorter end of the maturity curve, the wings become so steep that it kind of throws off your whole three-dimensional calibration. So really, we think that the short dated stuff is a little bit harder to deal with than the long dated things. But that's at least my opinion.
You and anything to add to that?
Yeah, I'd broadly agree with that. And it's the jumps at short maturities are definitely an issue, but we've sort of circumvented that by not looking at the dynamics of the underlying directly.
Hmm.
We're saying by comparing it to other implied surfaces in a different space, we're saying the option market will have figured that out. And so this comes back to the fact that we're using a non-parametric, not a pricing model, but we're just saying similar people with similar problems have done it this way. So that sort of helps us in that regard. Long dated options don't worry me nearly as much. I
Right.
wouldn't say worry is the right word, but as a technical problem, I don't think they're as difficult. But this does work for short dates as well, because we're using implied information. And also, your implied volatility can be further off at a short dated option because the amount of vega you've got is going to be much lower. So I think because of all these different factors, I'm pretty confident this works over the entire surface.
That's I think those are good observations. Yeah, I agree, and I think the hope for something like this is as it gets tested in the marketplace more, longer dated options are going to be useful. I think they'll be an important component of product building. So it's not surprising, but it's great to hear that. It's great to hear that. So I had one more question, but that I do want to bring in Kelly. Kelly's been patient, and Kelly, Kelly's Derive is going to be a user of this product. I think when did you hear about this methodology? How did you get comfortable with the idea of integrating it? And then we'll talk about that first. I want to hear a lot more about Derive too, make sure that everybody knows what they do. But just to punctuate this topic, how did you get involved, and how did your firm get convinced?
Yeah, so we've been working with Amber Data for some time now on a bunch of different aspects, and this is something that came up, I think, in early ideation phase, talking with Greg about sort of solving the problem of liquidity and marks and capital efficiency on altcoin vol surfaces. And one of the things I think Sam mentioned that's really works well with Derive and this methodology is how scalable it is, because doing things on chain in the manner that we're doing it allows us to iterate very rapidly. And, as we get comfortable with a methodology like this and have success launching a number of alt option markets and surfaces, we can scale very, very quickly the amount of offerings that we have. So I would say we got a very early look from Greg at sort of updates along the way of how this has been coming. We're very
And
excited.
in particular, so let's say you want to launch a new listing on a token that doesn't have an options market. You start with the surface. Are you market making around that surface on day one, or is this basically a canvas around which market makers will kind of begin to have activity, or how does that actually move from this implied surface into an actual market with liquidity?
Yeah, so the way that we use the vol surfaces is actually not anything to do with the way the market makers are pricing, but more it's used inside of our margin system. So we use the implied volatilities, we consume I think it's the SVI parameters on chain, and then we back out an implied volatility skew, and then from there informs the options marks that are a part of the margin system that decide whether you are above or below your maintenance margin and whether or not you're going to get liquidated. So it isn't biased to the opinion of market makers. You know, some may quote higher or lower than that, and that's fine, but use it as a source of truth for the risk in the system.
I understand. That makes a lot of sense. But in effect, even just for that use case, the market makers do have to subscribe to it to a certain extent, right? Because that's what their risk is marked against. So I guess how did that process work of getting those market makers comfortable with the surface as a margin tool?
Yeah, so the way that it works currently is we use a mix of data from Deribit and other liquid exchanges. So this process will be new. It hasn't launched yet, but I think given the amount of backtesting you guys have done, and obviously we'll have some research on our own side, that we'll be able to get people very comfortable with it. And right now, the way that these altcoin options are quoted and traded and margined is very, very capital inefficient. I think for the most part, things have to be fully collateralized. Everything is like very opaque and traded OTC. And this is a way to provide some level of capital efficiency. It doesn't have to be perfect, but it allows us to, you know, enable some form of capital efficiency, transparency, and openness in that process.
Oh, that's a great answer. I hadn't really thought about that before, right? That you're starting from a place of, if there's no information, collateral management is going to be nasty, right? So at least starting with a surface where there is agreement between risk and market maker, you can start to input some capital efficiency into the system. I think, you know, folks may not be aware of Derive and its background and your background. So maybe it's certainly options experts who aren't crypto options experts may not understand. Can you go into a little bit of your background and Derive's background, please?
Sure. So I'm head of institutional partnerships at Derive, and I work, you know, on our liquidity side as well. My background is in risk management and market making, so nice fit. I originally was a trader at a prop firm in Chicago for a number of years, and I traded a bunch of agriculture options, pretty much everything that's listed on the CME, and eventually Bitcoin options. So when I came to that, I came to find what was then Lyra, an on-chain options AMM. We've since rebranded to Derive, which is the version that you see today. And I've been there helping build out this version and onboarding users, liquidity, market makers, and things like that. What was the other part of your question?
Well, I mean, how do you work with Amber Data, and you know, generally, because I think this project sounds like it was in the context of other things that you rely on them for.
Yeah, so we've been partnered with Amber Data for some time now. We use them in a number of areas. First, we consume a ton of different data from them. We use them for volatility feeds. We use their spot feeds. We also use their APIs for back testing strategies, structured products, doing different tests and analysis for, you know, funds or firms that come out and want to trade on Derive. And then we also use their listed in our UI. They provide beautiful iframes so you can track the volatility, progress, and history on Derive. So this is just like one more step forward in our partnership that I think we've been looking forward to for a long time.
That's great. Who are your, I guess, most sought after customers to use the exchange, and you know, what's the range?
So it is sort of everyone, but I would say our first and foremost would be providing a product that's suitable for institutional users, you know, hedge funds, family offices, things like that, with, you know, deep markets, tight liquidity, you know, and a really robust risk process. We also have a good contingency of retail and sort of the pro-tail type traders that come in. We have a super retail-friendly UI that's built out, and then an even simpler vault strategy that's become pretty popular in DeFi, where it's kind of a do it for me strategy. I think as we go, there's going to be a huge contingency of AI traders and users, and it's one of the really cool unlocks of Derive, because you're able to bundle all these different products together under one margin system and create any payout graph. So yeah, lots of different parties.
Do you have, this is one of the questions from the audience, do you do any market making internally in-house, or is it all outsourced through partnerships, or how do you organize your market making?
Yeah, so it's 100% outsourced to market making firms. We have many market makers that come in different areas. So we have some that are quoting on the order book 24/7. We have some that are on responding to RFQs. We have some that are quoting perps, some that do everything, some that just come in, weekly and trade the vol auctions. So it's a lot of coordination. We initially started as an AMM. I think at some point we'll probably add at least some version of that back in, but I think having many participants is really a great thing for the system.
Yeah, that sounds great. And you actually, oh, sorry, go ahead. Who had
Yeah, just
something?
to jump in on that. So one of the
Mhm.
nice things about sort of our customer basis, there's a nice overlay here. We have a GUI that basically shows, historical vol and all the SKUs, and you can see where things are trading on Derive versus say Deribit, and we've just actually recently included iBit options and things like that. That GUI, we've decided to make it completely free. So really the retail base can have a set of tools to really get a good idea of where vol is lining up and where it's trading. But the more prosumer and institutional base of our clients can get all the underlying data. So you're talking about option chain snapshots every minute going back multiple years or calibrated surfaces. And that really falls into sort of the set of tools that become market makers on exchanges like Derive. So that's, I think, been really kind of the key source of our partnerships is that we have similar customer bases and ways to serve those customer bases across the board. So that's something that's been really exciting between our partnership.
That's amazing. I think that certainly the free product, and now we have two terms here, prosumer or pro-tail. I'll have to think about which of those two that we've used on this call, but I think I like both of them, and I love the idea of comparing the new ETF options to the crypto native option space. I think people should definitely check that out. I do recall another question I had from earlier, and it's actually been supplemented by a great viewer question. So, equities don't trade 24/7. Equities have earnings. Equities have dividends. So they have these kind of news events and jump events. Did you, and maybe a good question for you, or maybe to Sam to substantiate what kind of adjustments needed to be made to take care of these kind of distinct events in how equities behave? Maybe you and I could start with you on that one.
Yeah, that's a good question, particularly with earnings. We're not really as exposed to that because of the tenors we're dealing with when we're looking at 7 to 30 days.
Right.
And also a lot of that is baked into the dynamics of the overall variance premium in each stock. So it is a very good question. And the other thing is, though, we are dealing with 2,000 different stocks. So we have plenty of things which don't have earnings at any given time. So like I said, I really appreciate it. It's a very good question, but it doesn't worry me unduly. Let's put it that way.
I understand. And so a trading the path or the investor experience, the market experience of an options user during an equity trading day and a 24/7, you're comfortable that those are kind of the same, even jumps around closes and opens. Well, it's going to come out in the wash, right?
Well, okay, that's the part of the question I hadn't addressed, which is also a good question. That mainly impacts how you'd estimate the volatility for the level of the surface. And it's easier for crypto. I mean, frankly, 24/7 markets make estimating a time series problem much, much easier. The hardest thing in equities is how to integrate that overnight jump with your intraday volatility. And that's one of the things I was super happy I didn't have to deal with, because that is a really big problem.
Right. No, that makes sense. I want to make sure we hit these questions. This is a bit of a jump, but back to you, Kelly, on Derive. What chains does Derive use?
Yeah, so Derive, you asked what chains?
Yes, that's right. Which layer ones are you using?
Derive is part of the Optimism superchain. So we are actually our own L2. We share a set of standards and code base with Optimism, and we settle all of our transactions to Derive chain, which eventually settles to ETH L1.
Got it. Okay, that's good. I wanted to make sure we got that involved. So this is great. So we have a model where you can basically take any token, you can look at its properties, you can apply this non-parametric modeling, you can create surfaces. Greg, you've been one of the champions of the crypto options market for years now, and I guess probably few people have as good perspective as you do on the state of play right now. Both in terms of what's available and what people actually need, right? It's a pain in the neck to be an options market maker 24/7 when things come and go. So do you think that the market has developed in a really constructive way, let's say over the last year? And where do you see that evolution being most promising?
Yeah, absolutely. Well, as far as if the market's been developed in a constructive way, I think, Deribit and Paradigm together have been really big leaders in terms of a reliable exchange and then be able to settle block trades through Paradigm, quote, and settle block trades. So that's been really kind of foundational to the industry. But where we're going in the future is very interesting. So now that we have, first of all, the spot ETF, this actually introduces a class of investors with a different cost of capital. And what I mean by that is that if we look at Deribit options, they're all futures options. And when we're in a moment like we are today, where the market's very bullish, you get this basis into the futures market of 20%. We've seen as high as 40% annualized. And so what essentially happens is if you want to get leveraged long, you essentially pay a really big premium. If you are now able to use a prime broker and get long the spot ETF and then essentially short the CME futures against it, that converges a lot of that premium. And the reason why you can do that is because you have a class of investors that can get into the ecosystem that don't have a cost of capital of 20% or 40% to get into the blockchain world. They have essentially their prime brokerage balance sheet cost, which is usually around risk-free rates. So that's going to converge a lot of the different dynamics that have been playing around in crypto vol. I'm really interested to see how that plays out. The other thing that's been a big moment is we had IBIT options launch, about 2 weeks ago, and day one trading was about 50% of the Deribit volume. So Deribit, for those who are new to the space, the number one crypto options exchange, great team there, reliable exchange, and they've been holding market share about 85% ever since they launched. And now to have IBIT options trading about 50% of the market share, to me, that's showing us not only that there's an appetite for US investors and institutions to start trading this stuff, but this is essentially the inflection point for crypto vol, I think. Crypto vol is an extremely, extremely small space compared to traditional finance vol. And now we're going to have those traditional finance players come in. So really interesting to see how things like the variance risk premium behave, how the underlying basis behave, and essentially the path of vol. Does it remain an upside kind of vol skew? Does it switch into a downside vol skew as passive investors start to own Bitcoin and essentially buy puts and sell covered calls? So we'll see very interesting flows here.
Huh. I wanted to dig in a little bit on one of the points that you made, and I'm sure you've been watching some of the back and forth on crypto X or crypto Twitter about this topic of whether the ETF options are going to experience kind of the YOLO 100 strike call buying, and that's going to characterize their use. I think, one point of view, I think you partially made it in your previous comment, was that upside call buying in crypto native space to a certain extent represents the funding and the banking that's available in that space, right? So buying a 100,000, well, now that's not so interesting, but buying a 200,000 strike Bitcoin option on Deribit may be the best way for you to get implicit financing for that position. Whereas buying a 100% out of the money call option on IBIT may not be as interesting because financing is just much easier to get, right? If a bank can use it or retail can use it. So What's your thought on whether options use, I guess, how would you expect options use to differ between US onshore listed options and offshore crypto native options, given that the financing situation is different? Does it lead to different strategies, and does it lead to sort of different kinks in how, especially the upside part of the volatility skew might work?
In my mind, long-term trends that those things should converge. I think that the financing costs of, the basis trade in the TradFi world of long IBIT, short CME vol will bring down basis in Deribit, Binance, all those other exchanges. To me, that's essentially how it should work. In terms, I think there's an argument of like, are people going to pile long into out of the money calls versus become structural sellers of out of the money calls and owners of puts? I think there's a long-term structural view and a cyclical pockets of moves. The way that I like to think about it is essentially like if we think about just supply and demand, is the retail demand, essentially the Wall Street bets demand for getting long out of the money calls greater in this moment, now that we're hitting 100,000, than the institutional pension fund owning 1% of Bitcoin, selling covered calls against that. That really to me is what's going to cause like the spikes, the ebbs and flows from moment to moment. But the structural trend in my mind has to be lower volatility, lower call skew compared to put skew, things like that.
That makes complete sense. I think any comments on that, Ewan or Sam? What do you sort of agree with that view? It's a behavioral expectations view. There's still some people out there who think that the YOLO trade is going to be strong, and that we're going to lead to these crazy kind of short gamma Bitcoin melt ups. That's going to be consistent. What's your view on that from your observations?
Yeah, I mean, I think I sort of have to echo Greg's comments, but I will say that I think just from sort of seeing some of the offshore flow or like the non-US trading, a lot of that I think is based on speculative hedge funds working on strategies and a variety of different directional bets. Whereas I find that just from observation, the traditional finance players tend to be a little bit more delta neutral. I think a good example of that was that a few months ago, we saw quite large balances of IBIT ETFs on a variety of different like traditional hedge funds like Millennium and so forth. And these players aren't making large directional bets on the price of Bitcoin. Rather, it's likely the basis trade that they're trying to squeeze out. So I feel like the directional profile or the style of investing is a little bit different, where it's a bit more speculative offshore versus when we go more towards regulated markets, it tends to be more delta neutral oriented structures.
That's interesting. I think I'm curious. Like I feel Bitcoin is going to be kind of its own thing. It's going to have its own behavior set, and to the extent you have institutions bringing Bitcoin onto its balance sheet, especially if they are someday financial institutions, there'll be statutory capital to hedge, and you'll have a whole new set of, I guess, objectives that options users have to have that will not exist in any other token but Bitcoin, right? I mean, we think there will be a big Bitcoin options market, a giant onshore index options market, hopefully our index, and then everything else is kind of fits into a different category. Can you see what kind of behavioral changes and how would this impact your model if you felt as if there were more mandated risk management and that became a more primary objective that you may not be picking up in your single stock kind of observations?
Yeah, in a way, it doesn't matter because we're always going to be able to find things that are similar at any given time. I would agree mainly with Greg that there's going to be a convergence in behavior between the TradFi part of the crypto world and the crypto part of the crypto world. I think that's actually not going to work in the way Sam says so much, because I think you're going to get a wider range of TradFi players involved. It won't just be the Millenniums, it won't just be the Citadels. I think you'll see a much wider range of objective uses in crypto. So there will be directional players. And whether that leads to a dampening in the craziness, I doubt that, because I've never seen a meme like, GameStop. So
Right.
I don't think crypto is going to manage to out meme some of the meme stocks we've seen. So I'm thinking there will be a convergence, and Bitcoin will start behaving much more like any other random TradFi thing.
That makes sense. And I guess I like all those comments. I think, Greg, your point about that there's going to be this, I guess, a systematic trend, but interrupted by periods or bouts of just the opposite, kind of is in line with the GameStop idea. Kelly, I guess we're getting close to the end here. I want to give you a last word before we go to any final comments, but how do you hope to balance? I mean, if you want to launch options markets on a lot of tokens, do you expect the behavior to be balanced enough that your market makers can kind of scale? Or, how do you think about expectations for behavior, over a broader set of tokens, especially small ones and especially meme tokens?
Yeah, so I mean, I think it certainly varies by asset class. I think there will be some tokens that make a lot of sense to hold order book liquidity for 24/7 that, you see an implied vol for and are able to, check your sanity check and decide whether you're getting in or out. I think there's others that will make a lot of sense to run through our RFQ platform, where market makers have a lot less risk than quoting 24/7. So I think we'll see a mix of both of those things. From a market maker standpoint, the biggest thing that we've seen them want to trade anything is just order flows. So if there is order flow and demand for it, they will be there to price it. It's what market makers do. So, as we got further down the tail, less liquidity, markets get wider, it can be more profitable. Things like your index are also great. Those create like huge trading volume opportunities and arbs, across, your CoinDesk index, BTC options, and the basket of, stocks, not stocks, but coins and tokens that are in there. So all of those things are great. And the capital efficiency is going to be a huge win as well.
No, fantastic. So, Greg, we're coming up on time. Any final words? I don't see a ton of options used around pure, rigid enterprise level risk management. Is that something that you can foresee happening in the near future? What are your other hopes for what happens in 2025, and how do you think this surface construction might help support that?
Yeah, definitely. Well, one of my big hopes is, besides exchanges like Derive, OTC desks can start using a lot of our marks for kind of a neutral settlement valuation. So even if they're quoting things their own way, there's kind of an industry agreed methodology that, okay, we can reference the Amber Data altcoin surface to really get fair value across the board, across all the different venues that people are trading this stuff on. I do think that the crypto segment of crypto is going to be the most innovative and most willing to try new things and trade new coins and launch new coins or trade volatility on obscure collectible assets and things like that. It's going to be really interesting. So I think ultimately the TradFi world is going to be the last to adopt. So, if we think a lot of like the TradFi coins that are still talked about a lot, like Litecoin and things like that, no one talks about that in the crypto side of the world anymore. Litecoin is light years away. So I think it's going to be a little bit like that, where the pioneers such as Derive really push the envelope of what's new and new opportunities. And then as things get more efficient, they trickle down into the TradFi side of the world.
Yeah, I think that's a great hope, and I think quite realistic. It feels like having a broad array of traditional exchange-based single token options in the United States anytime soon isn't really on anybody's bingo card right now. So I think that the behaviors and the evolution that you mentioned is probably a hope that's shared by many participants. Any final words then, Greg, or any other panelists? I think it's been a really rich session, and I think most people would have probably learned quite a bit about the availability of this. It takes me back a little bit to when a lot of volatility surfaces were marked by by crowdsourcing, right? By going around to all the desks and say, like, here's your Euro stock surface, here's your FTSE surface. And the marking was basically to peers, right? To the group of peers, almost in a LIBOR-like way. This seems like a similarly useful but much more scalable solution for basic risk management, which is going to become a much more important component for running businesses. So I think it's great to hear about it. Any other final words, or Kelly, go ahead, please.
Yeah, I would just add to that, sort of what Greg said, that there's a whole subset of these tokens aren't just about betting on price action. Now that there's all of these E3 staking and Bitcoin staking narratives and protocols that are coming to light, a lot of these projects that have a native token are using them to pay people, to ensure the crypto economic security of the underlying protocol, like their Oracle prices and things like that. And they need to hedge runway. They need to ensure that they're able to pay validators. And it's a huge subset for crypto economic security that isn't suitable for using traditional crypto instruments like perps. And I think that your guys' methodology is going to be a huge unlock, plus being able to do it on Derive and access these types of instruments that haven't been available to those types of protocols.
Wow, that's a whole nother webinar about treasury use and corporate finance use, not just thinking about investors and risk management areas. That's fantastic. I think we'll have to drop there, but I mean we could easily go another hour. This has just been a fascinating topic, and want to really thank all the panelists for joining today for this CoinDesk session, sponsored by Amber Data, and we look forward to seeing viewers and these panelists in future sessions. Thanks so much.